Right friends, welcome back to first capsule of 9th week. Every week you will have 3 capsules in addition to why and how and facts and figures. This first capsule you will have clear idea about what is the GDP, GNP, NDP, NNP as well as clear difference between GDP and GVA. And in the budget lecture I gave lot of clarity with regard to the capital expenditure and revenue expenditure. So similarly, after listening to this lecture, you will have clarity about what is gross domestic product, what is gross national product, and at the same time, what is exactly the difference between constant prices, current prices, and at the same time, what is the difference between GDP and GVA. So let us take it from the basics. Sectors of the economy: primary sector, secondary sector, tertiary sector. Primary is basically agriculture and its allied sectors. Secondary is basically industry and construction. Then tertiary sector is basically services sector like teachers, doctors, lawyers. And if you look at the pictorial representation, this represents the primary sector. Here this is mining, this is quarrying. Please understand the difference between mining and quarrying. From the pictures, it will be very clear to you. So, the primary sector constitutes agriculture, mining, quarrying, forestry, fisheries. So, all these things are sometimes known as agriculture and allied sectors. So, primary sector naturally deals with natural products. Then, second one is secondary sector. By using natural products, you transform them into some other products. So, this is secondary sector. Basically, manufacturing sector as well as construction constitutes secondary sector. Tertiary sector is basically service sector. This is teachers, doctors, then lawyers, then information technology sector. So, these are all examples of tertiary sector. And if you look at gross domestic product, after learning about what is the primary, secondary, tertiary sectors, now gross domestic product is one of the many indicators of standard of living in a country. It is only one of the many indicators and it is regardless of ownership, and at the same time here final goods and services produced are taken and production is within the country's borders. So, what I want to convey is after learning about these 3 sectors, primary, secondary and tertiary, the total value of goods and services produced within the geographical boundaries of the country. So, within the geographical boundaries of the country, the total value of goods and services produced through these 3 sectors of the economy, irrespective of the nationality of the persons, whoever are producing within the boundaries of the country, is gross domestic product. So, gross domestic product is basically, here please look into this, primary, secondary, tertiary, and total final value produced is gross domestic product. Here 2 things are very important while finding out gross domestic product. First and the foremost is this is produced within the geographical boundaries of the country, which involves 3 sectors. And at the same time, second important aspect is it is total final value. You may have a doubt what is final value. Please look into this picture. Final value means suppose the biscuits are made only with the wheat. If biscuits are made only with the wheat, exclude all other products for the time being. Please assume that biscuits are made only with the wheat and wheat is converted to wheat flour, and subsequently wheat flour is used for converting it into biscuits. So, here in the GDP calculation, you don't take wheat flour or wheat because everything is converted to biscuits. So, therefore, the value of biscuits is only taken. That is the meaning of final value. So, within the geographical boundaries of the country. So, 3-4 things please understand when somebody is asking you about GDP. It is the total value of goods and services produced within the geographical boundaries of the country. Second one is it is the total value of goods and services of all the 3 sectors put together. Then the next point is GDP does not recognize the ownership. Whoever produce in the geographical boundaries of the country, everything is taken, that is by Indian nationals or foreigners. That is not the matter for GDP. So, after learning about these things, now let us look at gross national product. National, the name itself indicates it is the total value of goods and services produced by the nationals of a particular country. So, please understand carefully, we discussed about gross domestic product within the geographical boundaries of the country. Now, we are talking about gross national product. Gross national product basically talks about nationals of the country. So, here to gross domestic product, you have to subtract the income of the firms owned by other countries' nationals in our country. I have given for example PepsiCo, Coca-Cola, and here these are not Indian companies, these are owned by foreigners. So, here the income generated in our country by Pepsi and Coca-Cola is to be subtracted. Please look into this. It will be very clear to you to understand gross national product. This is GDP, we have already learnt. So, what is to be subtracted? What is to be added? This is very clear from this slide. What is to be subtracted? The items to be subtracted is income earned by foreigners in our country. So, foreign firms like PepsiCo, Coca-Cola, Toyota, all these firms generate income, and the income earned by these companies in our country is to be subtracted. So, this is known as subtracting the factor income. And at the same time, Indian nationals have got some companies abroad. Look at Jaguar Land Rover. This is the company owned by Tata Sons. At the same time, Airtel Africa is there. This is owned by Indian Airtel Group. So, the factor income or the income generated by the Indian nationals abroad is to be added. Some Indians are working in America, and the income earned by those nationals is also to be added. So, here basically you can say the income generated by the nationals is gross national product. So, gross national product is GDP plus income from the goods and services produced abroad by the nationals minus income from the goods and services produced domestically by the foreign nationals. So, total value of goods and services produced in a country plus net factor income from abroad. That means, if some Indian national is earning in foreign country, that is to be added, and if some foreign national is earning in our country, that is to be subtracted. So, that is gross national product. Having learned this, you have to understand the meaning of depreciation. Why I am explaining you this word depreciation is to know about net domestic product, net national product. So far we discussed about gross domestic product, gross national product. Now I am going to introduce net domestic product, net national product. So before understanding that, you have to learn about depreciation. You see, this is textile mill. I have taken one example of textile mill. In textile mill, there are 100 machines. Suppose let us assume I am adding one machine this year. 100 machines are there. I am adding one machine this year. So, it should become 101, right? But the point is, one machine is discarded this year because of wear and tear. Because of wear and tear, what happens? Some of the machines after 10 years, 20 years, they have to go for scrap. They have to be condemned and will go for scrap. That means the addition of this capital assets may not automatically result in total addition. Some of the capital assets may be discarded in due course of time because of wear and tear. So, depreciation is the accounting method of allocating the cost of tangible asset over its useful life. So, depreciation concept is whatever you are adding to the capital assets in our country is not the net addition. That may be gross addition, but the net addition is you will get when you subtract depreciated assets. If you are adding 5 machines in textile industry, if 3 are discarded because of wear and tear, then the net addition will be 2 only. If you are adding 1000 machines and 100 machines are discarded or have gone into scrap, then the net addition will be 900 only. So, depreciation is the concept where because wear and tear, certain capital goods will become scrap or condemned. So, here the differentiation is very clear. So, net domestic product is gross domestic product minus depreciation on the country's capital goods, or you can say consumption of fixed capital, right. So, these words very important. So, here you have to subtract depreciation to get net. Next one is gross national product minus depreciation on the country's capital goods, that is consumption of fixed capital is net national product. So, I explained you about gross domestic product within the geographical boundaries of the country, gross national product. When you take into account factor income, then net domestic product is if you subtract depreciation on the country's capital goods, and net national product is gross national product minus depreciation on the country's capital goods. So, depreciation is the term which is associated when you are talking about net domestic product or net national product, right. So, gross domestic product, I would like to tell you once again, it is only the final value of goods and services is taken, right. So, GDP is clear to you, but I have to make you clear 2 things. One is, what is the difference between constant prices and current prices? Constant prices and current prices. So, what is the meaning of GDP at market prices? So, if these 2 things are clear to you, then entire chapter of GDP will be clear to you. Here, constant prices and current prices. I have taken one classic example of explaining you with regard to what is the constant price, what is current price. Here, let us assume India is producing only Britannia biscuits. Only India is producing Britannia biscuits. Let us go back to 2015-16. India produced 10 packs of Britannia biscuits and each cost rupees 10. 10 packs, rupees 10. So, what is total GDP? Rupees 100 was the GDP in 2015-16. Then let us come to 2016-17. Same Britannia biscuit packets. India produced 11 packs. Each cost rupees 11. Right? So, 10 packs became 11 and the cost became 11 instead of 10. Normally, increase in cost is expected. So, what is total GDP? 121. So, there is 21% in GDP. Is it real? No, it is not real. It is only because of inflation. You see, what is the real GDP? Last year 10 packs. This year 11 packs. So, the real GDP growth is just 10%. Then, what is nominal GDP? Nominal GDP when you consider inflation also into account. There is inflation of 10%, you see, 10 became rupees 11. Last year, the packet cost was rupees 10. This year, it became rupees 11. So, here there is inflation of 10%. Actually, real GDP growth is just 10%. Last year, 10 packs. This year, 11 packs. That is without considering inflation. That means 11 packs into constant price of rupees 10. 2015-16, if you take it as the base for Britannia packets, the constant price is rupees 10. So, to calculate GDP for 16-17, you have to take the constant price of rupees 10 only without giving inference to inflation. So, here what happens? 10 packs, production is 11 packs, So, real GDP growth is 10%. But if you consider inflation, then the nominal GDP growth is 21%. Right? So, this is the difference between real GDP, nominal GDP. Right? So, what is the real GDP? Real GDP is GDP measured at constant prices. If you look at India, the base year is 2011-12. So, our GDP is calculated with reference to constant prices of 2011-12 without considering inflation. So, that is the real GDP. Real GDP is also called GDP measured at constant prices. And in the present example, I have taken 15-16, 16-17 only for the sake of example. But in India, for calculating real GDP, the base year is 2011-12. So, in this classic example, real GDP growth is 10% because only 10% increase in production is there. Last year 10 packs were produced, Britannia packets. This year 11 packs were produced. So, there is an increase of just 1 pack. So, real GDP growth is 1 pack over 10 packs, or you can say 10%. But cost increased by 10%. So, if you calculate at current price is 11 rupees in 2016-17. So, if you calculate at current prices, then the nominal GDP you call it is 21%. So, real GDP is without giving any effect of inflation with reference to some constant base year. And this is nominal GDP. Nominal GDP is in the biscuits example, it is 21%. So, nominal GDP is GDP measured at current prices. So, constant prices is real GDP, current prices is nominal GDP. So, this difference please understand. So, there is one term GDP deflator. GDP deflator is used as nominal GDP by real GDP into 100. So, in this classic example, you can substitute and find out what is the GDP deflator is. Nominal GDP by real GDP into 100 is GDP deflator. So, GDP deflator is used between nominal GDP and real GDP as a ratio multiplied by 100. Please don't forget, constant prices is real GDP, current prices is nominal GDP. So, our GDP is calculated as GDP at constant market prices. Constant market prices. So, before understanding what is the meaning of market prices, now you have to have some idea about how GDP is calculated. There are 3 methods of calculating GDP. One is value added method, second one is expenditure method, third one is income method. These things are clearly explained in the economy of 11th class. Please don't go into those details. Now, value added method. Now, Reserve Bank of India is very much concerned about gross value added, right? And now we are going to discuss about what is gross value added, what is factor prices, what is basic prices, what is GDP at market prices. So, please remember, we already discussed about GDP at constant prices. Now, we are going to deliberate GDP at market prices. Here, factors of production. If you go back to basic economy, factors of production will be there. Factors of production basically looks at what are the factors required for producing something. Whether it is goods or services, it doesn't matter. What are the factors required for producing something? And please don't forget, land, then labor, then capital, then entrepreneurship. These are very much essential for producing something. So, these are called factors of production. So, on land, one has to pay rent, and for labor, one has to pay wages. For labor, if labor are engaged, wages are to be paid. So, if capital is borrowed from market, if capital is borrowed from a bank like SBI, interest is to be paid. Then entrepreneurship, they have to get profit. to do the business. So, these four are known as these factors of production: rent, wages, then interest, then profits. If you combine together, it is value added. So, value added is the sum total of rent, wages, interest, profits. If you look at expenditure method, quite often I explain you about these things. Expenditure method is, this is basically final consumption expenditure by people like you and me. Investment expenditure, this is by private persons, or you can say private investment, entrepreneurs do investment. So, this is private investment. Then the next one is government expenditure, this is very important. Then net exports. See, these four put together is the GDP, this is expenditure method. So, for the time being, forget about this. Let us only concentrate on value added method. So, I have already told you value added method is rent, interest, wages, profit. So, these four if you add, because these emanate because of factors of production. So, if you add these four, that is a gross value added at factor cost. It is known as gross value added at factor cost. And for this, you have to add production taxes. Please differentiate between production taxes and product taxes. Similarly, production subsidies and product subsidies. Please differentiate between them. So, here this is gross value added, this is rent, interest, wages, profit put together is at factor cost, and if you add production taxes, subtract production subsidies, you will get gross value added at basic prices. What are production taxes? The entrepreneurs, while producing goods and services, they have some expenditure like registrations, registration taxes. Similarly, for the registrations or for some other aspects, this stamp duty is to be paid by the entrepreneurs. Similarly, property tax, they have to pay property tax every year to the municipal authorities or the other civil authorities. So, like this, there are some production taxes. These are incurred by the entrepreneur in due course of production of various goods and services. So, these are to be added, and this production subsidies are to be subtracted. Government gives lot of subsidies to MSMEs. Small and micro enterprises, normally government give lot many subsidies, interest subvention is given sometimes, and input subsidies are given by the government to agriculture sector. So, these are the aspects which are to be subtracted because government is giving directly inputs. So, here at factor cost, if you add production taxes and subtract production subsidies, you will get GVA at basic prices. So, this is GVA at basic prices. If you add production taxes to GVA at factor cost and subtract production subsidies, you will get GVA at basic prices. And let us go ahead. We are interested basically GDP at market prices. GDP at market prices. As we have already discussed, GVA at factor cost plus production taxes minus production subsidies, we get GVA at basic prices, and for this you have to add product taxes and you have to subtract product subsidies. And please differentiate, a short while ago we discussed about the production taxes. In due course of production, the expenditure by entrepreneurs is production taxes, and product taxes is something different. Product taxes are basically the taxes on the final product like excise duty, service tax, all these things, right? So, then product subsidies are to be subtracted. Product subsidies or final subsidies given. Sometimes government give product subsidies like on onions, kerosene, LPG, pulses. If government gives these type of subsidies, that is the product subsidies. So, these product subsidies are to be subtracted. Then product taxes like excise duty, service tax is to be added. So, then you will get GDP at market prices. So, finally, the GDP what we are calculating and what is published is GDP at constant market prices. GDP at constant market prices, and constant means base year 2011-12 without giving effect to inflation. Then market prices is after this due procedure it is followed. So, finally, before concluding this lecture, please look at these two. GDP at market prices is GVA at basic prices plus all taxes on products minus all subsidies on products. And if you go from GVA at factor cost, then this equation will come, right? So, this is all about GDP at constant market prices. So, GDP calculation by value added method, primary, secondary, tertiary, and total final value is GDP, and what we follow is GDP at constant market prices. So, finally, in a nutshell, this is without considering inflation. It is with reference to certain base year, which is 2011-12. Then all the taxes are to be included, all the subsidies are to be subtracted. Then we will get GDP at constant market prices. I hope you understood very well about GDP, then gross national product, net domestic product, net national product, then what is the difference between GDP and GVA, right? So, with this, let us conclude today's first capsule, and you already learnt about capital expenditure as well as revenue expenditure in budget sessions, right? So, have a nice day. Thank you.